Joining me to check the charts is Stephen Suttmeier, America Securities Chief Equity Technical Strategist. Stephen, it's great to see you. Let's start with this supposedly bearish sentiment. A lot of people think households are actually acting quite bullish about stocks right now.
Right. I mean, we took a look at the AAII bulls to bears spread, meaning when that's a positive reading, there's more bulls than bears, and when it's negative, there's more bears than bulls. And entering the month of December, you actually had more bears than bulls in the market. And then last week got a rally, and that rose a bit to 17.6 bulls over bears, which, is telling us that we have a catch-up trade in the making here. Investors getting more bullish as the market rallies. But what's really important to note is that the peak excessive bullishness reading on that indicator is around 28 to 32, which is where it was earlier this year. When the market rallied into July, it was a lot higher than where it is now. So I think there's room to run based on that.
So maybe we can take a little bit of a deep breath about that one. You're also charting a few other kind of measures of market sentiment right now, like the advanced decline line, which tells you what exactly?
Well, the great thing about the advanced decline line is that it went to a new high even before the S&P went to its own new high. So it tells us that market breadth is broad in the market and there's plenty of participation, which I think is very important. So when you have strong breadth, the market breaks new highs. It suggests that those new highs should continue. We do have a case to be made that we could be 6150s, 6180s on the S&P, even into year end this year, based on some technical breakouts that we have seen.
Say that again. You think we can get to where?
6150, 6180.
Okay.
Sometime later. Could be the Santa Claus rally that gets us there. Could be early January, perhaps. But there is a case to be made that especially if we can hold somewhere near or north of 6,000 on the S&P, there is additional support around that 5870, 5850 range. So plenty of support in the market, good breadth. And investors not too bullish. It's a good combination.
So then let's kind of pivot to something slightly more tactical, which is growth versus value. A lot of people don't even want to hear about value anymore, but walk us through what you're seeing there.
What I think is very interesting is when you look at Russell 1000 growth relative to Russell 1000 value, a lot of folks actually, do want value to outperform, but it's not the case.
Right.
Growth broke out relative to value earlier this year. It retested that breakout. And you got rising longer-term moving averages that support growth over value. So I think the growth trade over value still supports the case to be overweight growth and underweight value, at least when you look at that particular ratio. Also, there's some technicians that we're looking at a head and shoulders top on that has indeed failed. So when you have a topping formation on a chart that fails, you tend to get an equal and opposite reaction, meaning that if the top was favoring value over growth and it fails to complete that top, guess what happens?
Growth is back.
Exactly. You get growth stocks beating value stocks, and I think that's where we are now.
Well, the value people don't want to hear it, but most people invested in the market broadly nod and say that makes sense. And indeed, that may yet be the trend. I really appreciate you joining us today, Stephen. Thanks so much for your time.
Yep, thank you.
Stephen Suttmeier, B of A.